Good morning. You're watching Daybreak on Bloomberg Quint Live, and I'm Alex Matthew. Let's look at the headlines this morning. Asian markets are set to post their second straight week of gains. The dollar weakened in overnight trade. Oil prices fell after US President Donald Trump criticized the OPEC for rising oil prices, saying that the cartel must bring prices down now. The Reserve Bank of India has given a 4-month extension to Yes Bank chief Rana Kapoor. Kapoor will now have to step down from the post by January 31st, 2019. Graphite India will be in focus after the Karnataka State Pollution Control Board asks for the plant to be shut down. Company claims that emissions were within prescribed limits. Samara Alternative Investment Fund will buy Aditya Birla Group's retail chain more for an enterprise value of 4,200 crore rupees. All right, with that, let's turn to the international markets. And the US stocks were buzzing yesterday, and they vaulted to a record high on Thursday as investors brushed aside fears of the escalating international trade war and instead focused on a better than expected jobs growth and wage data in August. There was also news from China that it could be planning to cut average tariff rates on imports from the majority of its trading partners as soon as next month. It's not yet clear, though, how that will affect imports from the US. Abigail Doolittle of Bloomberg News wraps up all the action on Wall Street in this report.
There was a risk rally in Thursday's Wall Street session with both stocks and commodities finishing higher. The Dow and the Nasdaq were up about 1%. The S&P 500 climbed by about 0.8%. And both the Dow and the S&P 500 put in record highs. For the Dow, the first time since January. So the bulls really out also with that commodity complex higher, up for a third day in a row. Buyers, investors, traders looking past trade war fears, perhaps looking at the recently announced tariffs as being a little bit less severe than what had been anticipated. As for sector breakdown, tech did really quite well, rebounding from Wednesday's small decline, up more than 1%, helped out by lots of the big tech names, including Apple, Microsoft, Alphabet, and Facebook. As for Microsoft, those shares had been lower yesterday, but rebounding nicely, up more than 1%, putting in an all-time high. The financial sector did well as well, up more than 1%, or up about 1% after Wednesday's significant rally. Very strong on Wednesday, strong on Thursday, really being helped out by rising yields. That's thought to help out the lending activities of the banks, so the likes of Citigroup, JP Morgan, Bank of America, all up about 1% or more. And the fact that yields were rising, that of course tells us haven bonds were pulling back. That makes sense considering that stocks were higher. Now all over the map, Tilray, those shares finishing down more than 15%, at the lows down more than 20%. So an official bear market. This of course is the high-flying pot company on the week, up more than 50%. So lots of volatility and frenzied buying there. Investors trying to figure out what's next. I'm calling it a bit of a casino and comparing it to Bitcoin. One thing we do know for sure, lots and lots of volatility for Tilray and some of the other pot-related companies, cannabis companies. Overall, though, with stocks sharply higher, commodities higher, haven bonds lower, Thursday's Wall Street session was risk on. In New York, Abigail Doolittle, Bloomberg News.
All right, well, that's the update coming in from the US. Those markets clearly ended on a high yesterday. Let's see how they end the week. But in fact, from the early signs, it looks as if the Asian markets are set to end the second week in a row in the green. You have the early risers in Asia, the Nikkei, the Australian benchmark, and also the Kospi, all of which have started the day in the green. The Nikkei, in fact, with gains of about 0.5% or more. You have the Chinese markets that are just about opening up, and the Hang Seng as well that is opening up in the green, but perhaps a little too early to see which way the wind is blowing there. The Hang Seng up more than 0.5% higher. Just a small mention on Japan. The Bank of Japan has unexpectedly cut the purchases of its super long bonds, so there's likely to be a bearing on the bond markets in Japan. And also in Japan, Shinzo Abe has been elected again as the head of his party. That sets him up very well to lead the country for the foreseeable future, and in fact for him to become the longest serving premier of Japan. But with that, let's turn to the Indian markets and see how we're going to end the week in all probability. Darshan Mehta is here to set you up for the day's trade and also to tell you what's happening in the futures and options space. Good morning, Darshan. positive cues from overseas.
Yeah, positive cues from overseas. Asia is doing well. The ASX Nifty is indicating well, so we are back after a day's break. But nevertheless, the market seems slightly robust after the bit of negative news that we've seen over the past few days. The ASX Nifty is indicating that probably 11,350 probably will be taken in trade today. So that's the traction that we are seeing. The ASX Nifty is indicating a gap up of almost 40 points at this point of time. How did the ADRs pan out in trade? Most of them ended with a positive bias. Vedanta, Dr. Reddy's, ICICI Bank, HDFC Bank, all of them ending with a positive bias and gains of over 1%. Wipro was the only one that was pretty much unchanged, but nevertheless there was traction that was seen on the ADRs. How did we pan out in trade? We were down by almost 44 points as far as the trade was concerned, but remember we were shut yesterday, and the SGX Nifty is indicating 11,350. So expect a gap up opening of close to 100 points as far as we are concerned. The mid cap was down almost 170 points, so that was down almost 1%, and small cap was down over 1%. So there was broader market selling that was seen. As far as the Nifty Bank was concerned, that saw a cut of 0.5%, and the Nifty PSU Bank was also trading rather weak in session. Now, some of the sectors that managed to move up, metal surprisingly was up almost 1.2% in trade, and as far as the sectors that didn't do well was the FMCG sector, which was down 1%, and the real estate down, which was over 1% in trade. How did the fund flows pan out in trade? FIs were net sellers to the tune of 2,000 crores. DIs bought in almost 1,200 crores in the cash market. So overall, heavy selling by the FIs in the market. As far as the contribution is concerned, the Nifty was down 44 points. It was basically some of the financials, the HDFC Twins and IndusInd Bank, which caused the drop that came in. But certain private sector banks managed to support. Kotak Bank as well as ICICI were up in trade. As far as the Nifty is concerned, you're seeing that there was a long unwinding that was seen on the market. Open interest was down almost 2.5%. Fresh short positions was seen on the Bank Nifty. Open interest build up of almost 4%. Now, if you're seeing where positions are being taken, there is obviously more call writers are becoming much more aggressive from 11,400 right up to 11,600. 11,200 seems to be the support for the market, and that's from where the market seems to have bounced back, and that's what the SGX Nifty is indicating. What happened in trade on Wednesday? Let's take a look at that. And clearly call writers were aggressive, and since the market fell, put writers actually started shedding positions in open interest. The Nifty PCR managed to come down. These are the stocks in the F&O band. So Adani Enterprises and Balrampur Chini were already there. The new entrant is Wockhardt Pharma. As far as the PCR is concerned, Nifty PCR came down to 1.14. The Bank Nifty PCR also manages to inch down to 0.43 at this point of time. A couple of stocks I want to point out. Jet Airways saw open interest build up of negligible open interest build up, but there were fresh short positions that were taken on the counter. You had Reliance Infra, which was down 10% on low open interest build up. The entire Reliance ADAG pack was down in trade, and you can see Reliance Capital, there was a long unwinding that was happening. And the final stock that I want to point out is MCX India, which saw short covering that came in on Wednesday.
All right, thanks so much for that, Darshan. Now, a small note to our viewers who have tuned in on multiple social media platforms. Do let me know what you think, but I can only understand English, Hindi and Marathi. What seems to be Spanish, I can't really get that. Anyway, let's move on and talk about the next update for you. India's domestic economy may be strong enough to see it through tough times, but rising crude prices and a rising trade deficit are just some of the factors that have prompted JP Morgan to change its stance to neutral in India. Neeraj Shah caught up with the brokerage's India equity head Bharat Iyer and started off by asking him to list out the strengths and the weaknesses or risks in India.
Are there cyclical headwinds? Absolutely, which is the reason, if you'll recall, we used to be overweight on India within emerging markets for a long time. And last year in the fourth quarter, we actually took India a notch down from overweight to neutral because of these cyclical headwinds that you mentioned. Because as we all know, India has two key vulnerabilities: dependence on external capital, dependence on external oil. And both those seem to be going up. The cost of both seems to be going up. And it's difficult to really put a time frame as to when we reach the top there. And also, as you mentioned, we do have a meaningful political calendar, which means lesser policy flexibility. But that said, I guess there are positives too on the anvil. I think the one big positive that we see is that earnings growth is recovering, coming back after a long time. We've had 3 or 4 years of very anemic earnings growth for various reasons. And this year, I think, we saw the first quarter earnings growth of almost high teens. And we do believe that this year corporate India will deliver mid-teen earnings growth. So, that's a reasonably powerful driver of markets. And also, again, the big theme these days, obviously, is, the fear around trade wars. And, India being such a small part of the global supply value chain means we're relatively insulated. So the way I'd look at it is, it's not a glass which is full or which is empty. It's half full. I think the structural drivers are still very much in place. Be it demographics, be it the ability to absorb capital, be it the long list of reforms that have been implemented over the last 2 years. And yes, but there are cyclical headwinds, which is the reason we believe that, this is again going to be, the next 12 months will again be a phase where, returns expectations should be modest. We are looking at about 10% returns for Indian equities in local currency terms. And of course, there will be attendant volatility and noise because of the election calendar.
Interesting. So, does this 10% odd returns, or whatever the number would be eventually at the end of the next 12 months, be hinging significantly on the delivery of that earnings growth? Because at 19-20 times, we are effectively pricing in a 20% earnings
Absolutely,
growth.
Neeraj, because the way we look at it is, the hard work will here onwards have to be done by earnings. See, valuations have expanded meaningfully. We're trading at 20-21 times forward earnings, as you mentioned. Very little scope for valuations to go up further. Because, a bulk of the reforms have been announced. We see very little scope for, big bang reforms to be announced over the next 8-10 months, given the election calendar. And on the margin, cost of capital is going up, both locally and globally, which would suggest that, valuations, if anything, have to derate gradually, which means the bulk of the hard work will have to be done by earnings growth. And that's where our construct of a 10% return comes in. We're looking at 15% earnings growth, but we do believe that you have to keep some margin of error for valuations derating, and which is the reason we're calling for 10% return from the markets.
All right, interesting conversation there. You can watch the entire conversation at 9:30 a.m. on Indian Open today. All right, let's take a quick check on the rupee and the bond market now. Saloni Dhanuka is joining in with the details there. Saloni, dollar weakened overnight. What's the bearing likely to be on the Indian markets?
So, in fact, it's a big positive for Indian rupees. I'll talk about how it performed on Wednesday. It rebounded by close to 60 paise or 0.8% higher versus the dollar at 72.38 levels. In fact, the home currency snapped its 2-day losing streak after RBI intervened in the currency markets to restrict the rupee breaching the crucial 73 mark. On the global front, the sovereign bonds in fact gained on Wednesday, as we have seen 10-year benchmark bond yields dropping nearly 7 basis points to end at 8.07%, while on the global front, as you mentioned, dollar index now trades nearly to its 4-month low as emerging market currencies rebounded amid improving sentiments. So the index now trades lower for the third straight session, well below the crucial 94 mark. That apart, if you see pound, it rose over 1% yesterday versus the dollar, largely on the back of strong UK retail sales number, while euro trades higher versus the dollar for the third straight day. That apart, if you see dollar rupee now, it is trading at 71.95 levels against the dollar in the non-deliverable forward markets, which indicates a positive opening for Indian rupee in today's trade. Alex, also I would like to mention a PTI copy mentioned that India might pay Iran in Indian rupees for the oil imports starting this November. If this comes true, it will be a big positive for Indian rupee in today's trade, Alex.
Yeah, but I think there's obviously that. Thanks so much for that, Saloni. But clearly also have to weigh in the possibility of sanctions from the US, because trading with Iran is a big no-no from their end. All right, let's talk about the next update for you. The government may be weighing various options to stem the drop in the rupee, but Sajid Chinoy of JP Morgan says bolstering an already substantial forex reserve is not really the solution. Speaking to Ira Dugal on the sidelines of the JP Morgan India Investment Summit, Chinoy said India should look to ration its ammunition because it's likely to be a long and cold winter for the emerging markets. Listen in.
I get nervous when I hear that India needs more resources in NRI bond, because we started this process with $450 billion of reserves across spots and forwards, which by any measure is of given our current account and future gross financing requirements is adequate. So we've got plenty of reserves to finance any balance of payments gap at this point in time. and the RBI, can still use that. Now, I think the balancing act here, Ira, is that you don't want to use too many resources too quickly, because what's driving this are global phenomenon and global risks that may just persist for a while. I mean, the genesis of a lot of this is a stronger dollar because of US exceptionalism and the fact that the Fed will have to raise rates. That isn't going away. In the second half of the year, we expect the US will grow at 3%. We think for the Federal Reserve Bank, just to reach their definition of neutral will require at least 3 to 4 more rate hikes. And, most people would expect that the Fed at least has to go to neutral, given where their economy is. Growth is well above potential. The unemployment rate's the lowest in 20 years. Wages are picking up. In the 10th year of an expansion, payroll numbers are at 200,000. All this smacks of some overheating, and therefore the Fed will have to raise rates at least 3 or 4 more times. We know that trade war between the US and China is escalating by the week. So this could be a long, hard winter for emerging markets. And in that environment, the balance has to be that I don't want to use too many of my reserves as India Central Bank too early and have enough buffers left for the coming months. At the same time, I also want to try and reverse these one-sided expectations in the market.
Sure. Sajid, to the point that you made earlier on spreading this correction over multiple instruments or multiple aspects, I think Jahangir was making the point in a conversation earlier that you need to use interest rate in that. And his argument was that we have to look at CAD from the savings investment side. And if you look at it from that perspective, then higher interest rates have to be part of the solution. As the chief India economist, I'm going to ask you to fit that into the current Indian scenario. Given our growth inflation mix, do we have the option to use interest rates very much?
So I don't think there's necessarily an inconsistency here, because I think, firstly, the framework that the RBI is using has worked very well so far. And I think we should not fundamentally abandon the framework. Now, the framework itself is a flexible inflation targeting framework. So what the MPC has done well in the last few meetings is look forward and say, when the base effects wear off, where is inflation in the first 3 or 6 months of next year? And most of us forecasts are, at 5%, which the MPC deems will require some monetary policy response, and therefore you saw rate hikes in June and August. Now, what's happened since the August meeting? Oil prices have gone up almost 10%, and now expectations are that even $80 could be breached, because Saudi Arabia said 2 days ago that they're comfortable with oil prices above 80. And the currency, inevitably has weakened along with other emerging market currencies by about 5%. So my going forward, I think the cost push inflation that you saw earlier in the year will continue, because of higher oil prices, because of the weaker rupee. Yes, we're getting some relief from food prices, but we can't be sure how long that will sustain, given that MSPs have gone up quite a lot. So I think just using the existing framework, when you project inflation forward 6 months, at least in our models, we get headline inflation above 5%, and I think that will entail, some monetary tightening. I think we should not deviate from the course. Our expectation is we get a 25 basis point hike in October, maybe 1 more in December. Just looking at where inflation will be in the coming months. I know the MPC had said they'd rather it be closer to 4% and not closer to 5%. So at closer to 5%, you will need to respond, and that will help bring the current account down, because slightly tighter monetary conditions and sticking to your fiscal target should temper the current account deficit, along with the fact that later, with the lag, also the 7% real depreciation we've seen this year should also help. So I think policymakers will have the mix right, that multiple instruments will and are being used to try and narrow the current account deficit.
And you can watch that entire conversation at 1 p.m. on Power Lunch today. Now, Sajid Chennai was talking about the fact that crude might just breach that $80 per barrel mark, and it's not making a lot of people happy. In fact, one person who you'll probably all be aware of, US President Donald Trump, on Thursday suggested that the US may reconsider military support for countries in the Middle East if members of the OPEC don't bring oil prices down. His tweet comes ahead of a scheduled meeting among OPEC members and Russian officials this weekend, when representatives are likely to discuss whether to increase oil output. Bloomberg's Julie Hyman discusses Donald Trump's influence on the oil market with Bob Iacino, chief market strategist at Path Trading Partners. Here's a slice of that conversation.
I think currently it's being seen as rhetoric. I think the most that the White House can do to push down crude oil prices is larger and larger releases from the SPR, which we theoretically don't even need that much anymore. I think it's good to have, but there's a lot of barrels there that the president could just release. There's already about 1 million barrels due to be released in November, and that's really, I think, the only pressure he has. Given the current situation, the relationship is between Russia and OPEC, and they have a stated goal of stability and essentially market control. While they want to engage in renewables, they still want fossil fuel to be the main fuel, and they think they can control the price of market to keep that going longer and kind of push away that demand destruction that over time is probably inevitable.
Bob, looking at a chart of oil year to date, it's been in a range pretty much since, call it April or so, with 65 at the bottom and around 74 at the top. Do you think we're going to head back up to the top of the range, or do you think we're even stuck in a tighter range than that?
You know, I wish we were talking next week. To be honest, most of the time, I have an opinion on the direction of crude oil, and generally a very strong one. But given where it's trading now, given the seasonal factors, to me, fundamentally, it seems like there's an equal amount of bearish fundamentals and bullish fundamentals as we sit today. But we've got this meeting in Algeria between OPEC and Russia where they're going to discuss what they're going to do about the promised 1 million barrel increase, which Russia's almost completely consumed themselves, getting to post-Soviet era highs in production. That was announced this week. So I think it's a little confusing right now. When you look at what's going on with Iran, the sanctions seem to be working. Other than that, we don't have direction until post that meeting.
All right, we'll know soon enough the direction that crude oil takes after that crucial meeting of the OPEC and Russia. Let's move on now and talk about the banking space and, in fact, a particular private sector bank. No extension for Rana Kapoor. RBI has told Yes Bank that his term as MD and CEO will have to end by the 31st of January next year. This is the first instance of a promoter of a healthy bank being forced out of a management role. Vishwanath Nair brings us all the details in this report.
The Reserve Bank of India has asked Rana Kapoor, the MD and CEO of Yes Bank, to stepped down from his position after the 31st of January 2019. This decision was conveyed to the bank late Wednesday, after which the bank released a statement to the stock exchanges confirming so. While the reason behind the RBI's decision to remove Rana Kapoor from the leadership position at Yes Bank are not clear, analysts do believe that some of the recent news events at Yes Bank, especially regarding the divergence issue that came out over the last 2 financial years, could be a primary driving force. Remember that in 2015 and 16, Yes Bank reported a bad loan divergence of over 4,000 crore. This came out after the RBI conducted a special audit of the bank's books, and that found that there were certain assets which the bank had not disclosed as NPAs to its shareholders, even though they had shown all signs of becoming NPA. Following that, in the year 2016-17, the RBI conducted another round of the asset quality review, after which it found even larger divergences of over 6,500 crore on the Yes Bank balance sheet, and therefore these numbers were all disclosed to the Yes Bank shareholders in the forthcoming years. Now, this is the second time that the Reserve Bank of India has shown its power to change the leadership at a large private sector bank. Earlier this year, at Axis Bank, the Reserve Bank of India did not give an approval to Shikha Sharma to continue as the MD and CEO of the bank for a period of 3 years. In fact, her term will end at Axis Bank on the 31st of December, after which the HDFC Standard Life's current CEO, Amitabh Chaudhary, will be taking over as the head at Axis Bank. All eyes will remain on a board meeting that is going to be held on the 25th of September, where the board at Yes Bank will be deciding on the future course of action.
All right, now sticking with the banking space, amidst consolidation in the public sector banking space, the government has appointed managing directors and chief executive officers for 10 PSU banks with immediate effect. The list includes Allahabad Bank and Bank of Maharashtra, whose heads were sacked owing to investigations from law enforcement agencies. Now, S.S. Mallikarjun Rao and A.S. Rajiv will be heading Allahabad Bank and Bank of Maharashtra respectively. The post of MD and CEO of Dena Bank and Andhra Bank were vacant for over a year. J. Pakirisamy and Karnam Shekhar have been appointed to those positions respectively. The government has also appointed new managing directors and chief executives officers for Indian Bank, Syndicate Bank, Central Bank of India, UCO Bank, Punjab and Sindh Bank, and also of United Bank of India. So a whole host of bank names to watch out for, and in particular Yes Bank that you're going to have to watch out for in trade today. What are the other stocks in news? Well, Shraddha Babla is joining us to tell you exactly that. Good morning, Shraddha.
Good morning, Alex. So I'm going to start off with Max India, which will be in focus. Why? That's because Life Healthcare South Africa has sold its entire 49.7% stake in Max Healthcare to Radiant Life for 2136 crores. So that values Max Healthcare at 4272 crores. Now remember that Max India, which is a listed entity, it owns 50% stake in Max Healthcare, and the current market cap of Max India stands at just 2178 crores, suggesting significant potential upside. So watch out for that one. Graphite India has clarified on reports of pollution from its Bangalore graphite electro plant, based on which it was recommended to shut these units down. That's according to a report. But the company has said that they're confident that the stack emissions are well within the prescribed norm. So let's see how that moves in trade today. You also have Fitch Ratings, which has revised the outlook on Tata Motors from stable to negative, and this is on account of expectations of rising negative free cash flow over FY19 and 20. That's what the rating agency has said. They've affirmed Tata Motors long-term issuer default rating at BB+. NBCC has updated that they have secured business worth 922 crores in the month of August as compared to 228 crores that they had seen in the month of July. And finally, Dilip Bilkon, they have been declared as the lowest bidder for a Madhya Pradesh Metro Rail project for about 229 crores. Construction period is 2 years. Not a very big order win for this one, but nevertheless could react positively. So these are some of the names to watch out for.
Thanks so much for that, Shraddha. Now, clearly, there's lots, in fact, to look forward to at the end of the week. So you can find all the live market action right here on Bloomberg Quint Live. But there are also several stories on the website currently that you should, in fact, read. The government has increased interest rates on small savings schemes by up to 40 basis points for the October-December quarter, according to an official notification. And in huge news in the international aviation space, Dubai's flagship airline Emirates could be looking to take over unprofitable neighbor Etihad, according to 4 people familiar with the matter. That's a Bloomberg story. If it goes through, it would create the world's biggest carrier by passenger traffic. Both airlines initially declined to comment before later denying that any talks were underway. Well, that's all we have for you on this edition of Daybreak. Do remember to like if you like what you saw of the last half hour, and not too far from that, at least on YouTube, is the subscribe button, so do make sure you hit that as well. This is all we have for you on Daybreak. As I said, this is Bloomberg Quint.